I have seen property investors say maybe $100 a month on the interest, but then the loan setup locks them in.
The structure is so important to getting an investment property, but more so to be able to continue building on that property.
A lot of people assume the moment their property's gone up in value, they should refinance and pull out the money.
We had COVID, low rates, everyone's borrowing capacity was through the roof. People had a lot more opportunity to continue building on that capacity.
What are the key indicators you look at before advising them to tap into it? And how do we help them figure out if the timing's right?
The structure for long term, it needs to be considered, because at the end of the day, if you make one decision that can help you retire 5 years early.
Refinancing isn't just about a product conversation, it is a strategic conversation. If you look at the property market today, the people who are really accelerating buying their second or third investment property aren't necessarily earning more, right? They are simply structuring smarter. And one of the biggest levers behind that momentum is refinancing, not just chasing the lower interest rate, but using the equity they built to reposition their portfolio, free up the cash flow, and plan their next move, right? But as we know that the refinancing isn't as simple as it sounds, okay? Here, timing matters a whole lot, structure matters, and so does understanding how it fits into your overall investment strategy, right? So today I am joined by Diego, one of our property and finance consultants who's been helping investors and homeowners restructure and refinance for many, many years, right? We'll dig into how refinancing has evolved over the years, right? What smart investors are doing differently and what to look out for when you're planning your next move, right? So, mate, let's start with the shift that we are seeing in the last couple of years, right? Refinancing used to be purely rate driven, right? People would move their banks just to take 0.5% off their mortgage, right? But lately, we are seeing investors use refinancing as a strategic lever, right? They're tapping into equity to rebalance their portfolio, improve the yield, or restructure the debt before the next purchase, right? And I've noticed this particularly with the clients who bought pre-COVID, right? Property values have jumped and they're now using that increased equity not to splurge, but to get investment ready again, right? So from your point of view, from your side, what's driving this behavioral change? And why are so many investors seeing refinancing as a part of the wealth building plan rather than just a money saving exercise?
Absolutely. Well, firstly, thanks for having me on. And obviously one of the big reasons and big things behind that, as you mentioned, was COVID. It has driven quite a competitive and quite a big change to our property market, especially in Southeast Queensland here. We've seen obviously big movement, which is obviously, as you said, opened up a lot of equity. From the, I suppose, buyer's perspective, the big sort of differences at the moment, as you said, is that the change in structure makes a massive difference in being able to actually continue building on your portfolio. We were faced back about, it'll be 4 years now, where we had COVID, low rates, everyone's borrowing capacity was through the roof. People had a lot more opportunity to continue building on that capacity. Whereas now, unfortunately, with rates up, property where it is income versus debt, we're not in the same capacity where you can just set up any old loan and look at getting yourself into a investment property. The structure behind that investment and behind that finance needs to be set up in a much more, structured way to be able to give you that opportunity to be able to continue building on it. So I think the property prices with the rates where they are at the moment has sort of made it more of a necessity to be in a position where you need to focus more on the structure of the property rather than purely just having a loan.
Yeah, 100%. And I think that's the key difference, right? It's no longer about the interest rate, it's about the interest strategy, right? So now let's talk a little bit about equity, right? Equity is obviously a powerful tool, but it's also one of the most misunderstood concepts, right? A lot of people assume the moment their property's gone up in value, they should refinance and pull out the money, right? But that's not always the smartest play, right? I have seen, as I was saying in the beginning, that the timing matters a whole lot. And if you refinance right after a peak, valuation can shift, or if your income position isn't aligned, you might lose borrowing power, right? So when you are sitting with a client who's built, let's say, $300,000 in equity, okay? What are the key indicators you look at before advising them to tap into it? And how do we help them figure out if the timing's right? or if it's better to wait and strengthen their current financial position before they do anything?
Absolutely. Look, it's the age-old question is when is the right time to look? And I suppose it, from my perspective, comes down to a lot more of having the right conversations, asking the right questions. A lot of people at the end of the day don't understand what having an investment property entails and what it means to be in a position where you can start to invest. So now I think it's about 78% of all loans go through mortgage brokers rather than banks direct, because at the end of the day, the job of a mortgage broker, rather than giving you a mortgage, is to structure the loan to be able to put you in a position where you can continue building on that equity and continue building on your retirement plan. So I suppose the big with what you've mentioned, it comes down to having those right conversations. It comes down to asking those right questions and giving people the understanding in the long term what they want to achieve, so you can work backwards through the process.
That's a great point. And again, yeah, equity can definitely open doors, but only if the fundamentals, like for example, income, serviceability, and structure, they all line up at the same time, right? Now, here's something I think gets overlooked all the time: structure, right? I have seen property investors say maybe $100 a month on the interest, but then the loan setup locks them in, right? For example, cross-securitisation, unclear offset, and when they try to sort of refinance again or sell one property, the whole thing kind of really unravels, right? On the other hand, clients who focus on getting the right structure often pay slightly higher interest rate, but have complete control and flexibility over their assets, right? They can access equity faster, move between the lenders, and expand without friction, right? So when you look at the deals that we have done over the years, how often does poor structure become the biggest roadblock? And do you think the market is slowly maturing with people starting to value structure over short-term rate cuts?
Absolutely. And it is 100% becoming a lot more important to be able to take that time and focus on getting the structure right the first time. One of the things you mentioned there with cross-securing properties is just such a big risk to take, putting that much control in the bank's hands. Unfortunately, it comes down to a lot of the cross-securing. If you want to do anything, you must ask the bank's permission. And because the banks have internal valuation processes, which allow them to sometimes, I suppose, dictate what valuation they allow on a certain property, it does limit people quite a lot in being able to utilize equity within a property. Cross-securing is always something we've been quite against when it comes to looking at it from a continuous growth perspective. And you really want to be able to have those properties be malleable, be able to move, be able to do things with those properties to continue moving on that portfolio. Cross-securing aside, the structure is so important to getting an investment property, but more so to be able to continue building on that property, not so much focusing on the first and only, but looking at being in the future at those continuous purchases to continue building on that assets.
Right. And obviously, and do you think when you talk to the client that there's a shift in the mindset where people are starting to value structure over the short-term rate cuts?
100%. And it is, again, having the right conversations and giving your clients that right understanding of why the structure is so much more important than purely just looking at a rate. When you're sort of looking at from a high level and you're looking at a property, even at a minimum, making a 3% growth over time, you're looking at the difference of $3,000 a year in interest, maybe for a higher interest rate. When you're comparing that against the property that's got an appreciating asset at even 3%, you're making triple, quadruple what you're paying that extra in interest to be able to continue building. But as well as just the forefront of that property, it also gives you that opportunity to continue building and to continue to those same successful processes at work.
Right, I couldn't agree more. A well-structured loan is like a good architecture, right? It looks simple on the outside, but every part is deliberate and designed to carry the weight, right? So let's touch on the cash flow, okay? Because refinancing isn't only about borrowing more, okay? In the current rate environment, I've seen investors using to simplify, for example, consolidating multiple loans, switching to interest only for a period, or even using offset account to manage liquidity more efficiently, right? For example, when an investor with 2 or 3 investment properties refinances to restructure payments and align rental income with debt obligation, it can free up hundreds per month in cash flow, right? Which then can be reinvested or reused for the buffer, right? So how do you approach this kind of refinances? And Are you seeing more clients use refinancing as a way to manage the cash flow?
Yeah. Look, so on the last point you mentioned, we've been lucky enough where a lot of our clients have been fortunate enough to be in a position where obviously they feel the cost of living increase, but has not put any pressure on them as a household. We've seen a lot of our clients specifically reaching out to manage cash flow. However, one of the biggest things from what you mentioned earlier that we're noticing quite a big difference is a lot of people, obviously with COVID increases, have a lot more equity in the properties. They've all, or a lot of them have had their car loans that they're paying off, their credit cards, their zip pays, their afterpays, the things that they pick up along the way. And the minimum payments they're making between those three loans are enough to cover an investment property, to have a mortgage, to have another property continuing to grow wealth. So now with the added equity that they've got, a lot of people think, well, I can't afford to have an investment property, but the cost they already have would be enough to be able to suffice an investment purchase. So with using that equity they've got in the property to consolidate, it does give them that extra cash flow, which essentially everything they're already paying now, they're paying the same amount, but now they have an appreciating asset that's going up.
Right.
With your debts that you do consolidate, be it your car loans and things, you may be driving them over a longer period of time, but at the end of the day, if you end up having that consolidated, you might pay it off over 10, 15 years rather than 7, but you've also got yourself a property that's now grown at 3, 5, 10, 20% over that last 10, 15 years as well. The difference in interest you pay is negated by the appreciation of your asset.
Yeah. Makes a lot of sense, because again, healthy cash flow isn't about how much you make, it's about how well your money sort of moves through the system, right? And a well-timed refinance can completely sort of change the dynamic, correct? Now, before we wrap up, I want to zoom out and talk about where you see property finance heading, right? We are in a market where interest rates have leveled off, property prices are climbing again, and digital tools are changing how people assess and apply for the loans, right? What I'm curious about is the strategic side, right? How investors will behave differently over the next few years, right? Do you think we are moving toward a more portfolio management mindset where refinancing, restructuring, and equity release become a part of an annual strategy review, just like tax planning, right? Or do you think most people will still treat refinancing reactively, basically only doing something when there's a change in rates?
Yeah. Look, it's a great question. And obviously when you're looking at it from an investment perspective, I think it's over 70% of all investors only own one property. And then you have the smaller percentage of investments started to increase on that. So when you're looking at it from a high level, it does need to change to that mindset where they are looking at the finance as purely, rather than just saving a couple of dollars a year or $1,000 a year in interest, looking at what the finance can do to be able to help you increase that portfolio in the long run. The truth of the matter is, and what a lot of people don't realize is, in a home loan, be it most importantly your owner-occupied residence, you don't actually start paying more principal than interest until about your 18th, 19th year of your loan. So consistently refinancing that property, at the end of the day, you're never really getting yourself to a point where you're coming ahead. So the whole point of where you sort of look at structuring your investments is trying to minimize as much cash flow as you can towards those investments, and look at obviously focusing that towards your non-tax deductible debt being your owner occupied. The structure for long term, it needs to be considered, because at the end of the day, if you make one decision that can help you retire 5 years early, or help you look at obviously getting that 1 or 2 extra properties that you didn't have, for anybody, and especially those with kids, I'm sure you know 5 years can go past very quick. But when you look at it in the greater scheme of things, the amount of things you can achieve within that 5 years is incredible. And all it can take is 1 or 2 differences in that structure side at the start, that if that gives you that extra 5 years to enjoy your grandkids, enjoy your retirement, whatever that is, that's where it becomes far more important than just the dollar or cent at the end of the financial.
Yeah, that's a solid perspective, because at the end of the day, wealth creation through property isn't about how many assets you hold, it's about how effectively you sort of finance them, right? Refinancing, when you do the right, is simply how you keep those assets working harder year after year for you, right? So so just the parting notes: if you haven't reviewed your structure in the last sort of 12 months, it's probably the time to do that. Understand this: the markets change, lending appetites also shift, and a small tweak today can make a big difference in where you stand a year from now, right? Refinancing isn't just about a product conversation, it is a strategic conversation, right? And as we discussed today, when you approach it with the right mindset, timing, and structure, it becomes one of the most powerful wealth building tools available out there, right? If you found this discussion useful, give it a like, subscribe, and check out the next video where we unpack strategies around property finance and wealth creation in simple real-world language. Yeah. Thanks for watching, and we'll see you in the next one.
Thanks, guys.
Yeah.